When we talk about running a successful business in Denmark, sound bookkeeping is not just a regulatory requirement, it is a strategic asset. In this video, we will walk through some of the most common bookkeeping mistakes companies make in Denmark, and how to avoid them so you remain compliant, audit-ready, and in control of your financial performance. Let us start with one of the most fundamental errors: mixing personal and business finances. Even for smaller Danish virksomheder and enkeltmandsvirksomheder, using the same bank account or mobile payment solutions for both private and business transactions creates confusion, complicates your annual accounts, and increases the risk of errors in your tax filings with Skattestyrelsen. The remedy is straightforward. Establish dedicated business accounts, use separate payment cards, and maintain clear internal rules about which expenses qualify as business-related. This leads directly to a second common mistake: incomplete or missing documentation. Under Danish bookkeeping and tax rules, you must be able to substantiate every transaction with proper documentation, whether it is a digital invoice, a receipt, or a contract. Businesses often fail to collect receipts for small purchases, hospitality costs, or transportation, assuming these amounts are insignificant. Over time, however, these missing documents can add up to substantial sums, and during an audit, undocumented costs may be rejected as deductible expenses. To avoid this, implement a disciplined, preferably digital, process for capturing every receipt at the time of purchase, and ensure that employees know exactly what is required and how to submit records promptly. A third frequent issue is misunderstanding Danish VAT, or moms. Errors often arise around when to charge VAT, how much to charge, and how to handle VAT on cross-border transactions within and outside the EU. For example, some companies apply Danish VAT on invoices where the reverse charge mechanism should apply, or they deduct input VAT on costs that are partly private or non-deductible under Danish rules. Inaccurate VAT reporting can quickly become costly, as late payments and corrections may trigger interest and penalties. The best practice is to map your typical transactions, document which VAT codes apply, and use accounting software configured to Danish VAT requirements. When in doubt about specific cross-border services, consult updated Skattestyrelsen guidance or a local advisor rather than relying on assumptions. Another common mistake is poor alignment between the chart of accounts and Danish reporting needs. Many businesses simply accept the default setup from their accounting system without tailoring it to their industry, size, or reporting obligations. This can make it hard to distinguish between, for example, staff costs, consultant fees, marketing and development expenses, or to separate Danish and foreign sales. The result is that management lacks clear insight, and year-end work with the revisor becomes more time-consuming and expensive. Instead, invest a bit of time at the outset to structure your contoplan so it supports both legal reporting, including the annual report and tax return, and internal management reporting. Make sure income and cost categories reflect how you actually run and steer the business. Closely related is the problem of timing errors, or incorrect periodization. Danish businesses are required to recognize income and costs in the correct period, yet many smaller companies still follow bank movements instead of economic reality, for example recording an annual insurance invoice entirely in January rather than spreading the expense across the coverage period, or delaying revenue recognition until the invoice is paid rather than when the service is delivered. These practices distort profitability by month or quarter and can give a misleading view of performance. The solution is to apply basic accrual principles consistently. Use accruals and deferrals for significant items, ensure your accounting system supports periodization, and schedule regular reviews, especially around quarter and year-end. Another mistake, often underestimated, is inconsistent coding and lack of internal controls. If different staff members post similar expenses to different accounts, or if there are no clear approval workflows, bookkeeping becomes fragmented and vulnerable to both accidental errors and potential fraud. In Denmark, the bookkeeping law increasingly emphasizes traceability and internal control, including digitalization requirements. To address this, define clear posting rules, establish approval thresholds, and use system-based controls where possible. Simple measures such as standardized account descriptions, access rights in your accounting system, and segregation of duties can significantly strengthen data quality. Many companies also underinvest in the digital tools that are now considered standard in the Danish market. Relying too heavily on manual spreadsheets, or not integrating your accounting system with your bank, payroll, or invoicing solutions, increases the risk of manual entry errors and makes reconciliation cumbersome. Denmark has a mature ecosystem of cloud-based accounting platforms that integrate seamlessly with digital invoicing, such as NemHandel and economic integrations, payroll providers, and banking. Leveraging these tools can help automate reconciliations, enforce VAT rules, and create an audit trail, while also supporting remote work and collaboration with external accountants. Another trap is neglecting deadlines for VAT filing, tax payments, and annual reporting to Erhvervsstyrelsen. Danish authorities apply strict deadlines for periodic VAT returns, B-tax, and corporate tax prepayments, as well as submission of ARS-report for companies covered by the Annual Accounts Act. Missing these deadlines can result in fines, interest, and in severe cases, forced dissolution. Many small and medium-sized businesses struggle with this not because of complexity, but because responsibilities are unclear or reminders are not systematized. Counter this by maintaining a simple compliance calendar that lists all relevant deadlines for your legal form, assigning clear owners for each task, and using digital reminders or your accounting software's built-in alerts. Finally, an overarching mistake is treating bookkeeping purely as a compliance cost instead of a management tool. When bookkeeping is viewed only as a year-end necessity for tax and the auditor, it tends to be postponed, rushed, and delegated without strategic thought. Yet in Denmark's competitive and high-cost environment, timely and accurate financial data is critical for managing liquidity, optimizing tax positions, and making informed investment decisions. To shift this mindset, ensure you have up-to-date books at least monthly, review simple dashboards or key figures such as gross margin, liquidity, accounts receivable aging, and cost development, and use these insights in management meetings. In practice, this often means investing in training for internal staff or establishing a close, ongoing dialogue with an external bookkeeper or revisor who understands Danish regulation as well as your industry. In summary, avoiding common bookkeeping mistakes in Denmark is less about complex technical rules and more about disciplined processes, separate business and personal finances, document every transaction, handle VAT correctly, structure your chart of accounts thoughtfully, apply proper periodization, implement internal controls, leverage digital tools, respect statutory deadlines, and use your numbers actively to run the business. By addressing these areas systematically, you not only stay compliant with Danish requirements, but also gain a more reliable foundation for growth, financing, and long-term value creation.